Before we dive in, a quick but important disclaimer. I am not a licensed financial advisor, mortgage broker, or attorney. The information provided in this video is for educational and informational purposes only and does not constitute financial, legal, or investment advice. This presentation is a general overview and is not a substitute for professional advice. Please consult with a qualified and licensed professional before making any financial decisions. You run a successful business. You're a consultant, a freelancer, a contractor, the owner of a thriving e-commerce store. Money is coming in, cash flow is strong, and you have a healthy six figures sitting in your business bank account. You've done everything right. You've built something from nothing. So you decide it's time to buy your dream home. You walk into a big traditional bank full of confidence. You have a near-perfect credit score, a hefty down payment ready to go, and a portfolio of your work. Then the loan officer asks for the one thing that makes your stomach drop, your last 2 years of tax returns. And just like that, the dream dies. Your accountant, who you pay thousands of dollars a year to be brilliant, did their job perfectly. They used every legal deduction, every write-off, every loophole to minimize your tax liability. On paper, according to the IRS, your net income looks like you can barely afford to rent a one-bedroom apartment, let alone buy a house. The banker looks at you with a mix of pity and suspicion, and you're politely shown the door. Does that sound familiar? For millions of self-employed Americans, real estate investors, and gig economy workers, this isn't a hypothetical scenario. It's a soul-crushing reality. You are trapped in a system designed for W-2 employees. A system that sees consistent pay stubs as the only legitimate proof of income. It doesn't understand seasonal businesses, large one-time contract payments, or aggressive growth strategies where you reinvest every penny back into your company. You are a square peg being hammered into a round hole. And the financial world is telling you that despite your success, you don't deserve to own a home. But what if I told you there's another way? A way to get a mortgage without showing a single tax return. A way to have lenders look at your real cash flow, the actual money hitting your bank account instead of the number you report to the IRS. What if I told you there's a key that can unlock the door to homeownership for the entrepreneurs and innovators that this country was built on? This key is one of the most misunderstood and mythologized products in the entire mortgage industry. The no documentation loan. And in this video, we are going to pull back the curtain and expose the absolute truth. We're not just scratching the surface. We are going deep. We will break down exactly what these loans are, how they survived the 2008 financial crisis, and why they are completely different and safer today. I'll show you who they are for, and just as importantly, who they are not for. We'll explore the different types, from bank statement loans to asset-based lending. We'll talk about the real interest rates, the down payment requirements, and the hidden fees you need to watch out for. By the end of this presentation, you will know more about this niche corner of the mortgage world than 99% of the population, and you will be armed with the knowledge to decide if this powerful financial tool is the right move for you. This is the definitive guide for every entrepreneur who has ever been told no by a traditional bank. Now I know what you're thinking. The moment I said no doc loan, your mind probably flashed back to 2008. You're thinking of The Big Short, a financial collapse of ninja loans, no income, no job, no assets. You're thinking of a system gone wild, where anyone with a pulse could get $1 million mortgage, leading to a global economic meltdown. And you are absolutely right to be skeptical. Those loans were a disaster. They were irresponsible, they were predatory, and they deserved to be wiped from existence. And they were. Let me be crystal clear. The no-doc loans of today have absolutely nothing in common with the toxic loans of the pre-2008 era. They are a different species entirely. After the crash, the government stepped in with sweeping legislation, most notably the Dodd-Frank Act. This act created a new federal agency, the Consumer Financial Protection Bureau, or CFPB, and it established a new golden rule for all mortgage lending in the United States. It's called the Ability to Repay Rule. It's a simple, common-sense concept that was shockingly absent before 2008. The rule mandates that lenders must make a reasonable, good-faith effort to determine that a borrower has the ability to repay their loan. A lender can't just take your word for it anymore. They can't just look the other way. They are legally required to verify your ability to pay. So if a lender has to verify income, how can a no-doc loan even exist? This is the central misunderstanding, the marketing flaw that causes all the confusion. The term no-doc loan is a relic. It's a ghost from the past that, for marketing purposes, has stuck around. Today's loans should not be called no-doc. They should be called alt-doc, or alternative documentation loans. Because you are absolutely providing documentation. You're just providing different documentation. Instead of showing the IRS your tax returns, you're showing the lender your bank statements. Instead of showing them a W-2, you're showing them your assets. You are still proving, with mountains of paperwork, that you have the ability to repay the loan. The lender is just using a different, and for many business owners, a more realistic set of metrics to evaluate your financial health. Think about it. Which is a truer measure of your ability to make a $5,000 mortgage payment each month? Is it your tax return, which after business expenses, depreciation on equipment, retirement contributions, and a dozen other deductions says you made $50,000 last year? Or is it your last 12 or 24 months of business bank statements, which show a consistent $60,000 in deposits hitting your account every single month like clockwork? For a self-employed person, the bank statements tell the real story. The cash flow is the truth. And a new breed of specialized, non-traditional lenders has built their entire business model around understanding this truth. These aren't the big box banks you see on every street corner. These are portfolio lenders, private lenders, and specialized mortgage banks that understand the nuance of entrepreneurial finance. They don't sell their loans to Fannie Mae or Freddie Mac, which means they don't have to play by the rigid, one-size-fits-all rules of conventional lending. They create their own rules, their own underwriting guidelines based on common sense. They offer products specifically designed for the people the traditional system leaves behind. The most common of these is the bank statement loan. This is the workhorse of the alt-doc world. Here, the lender will analyze 12 or 24 months of your personal or business bank statements to calculate a qualifying income. They don't care about your tax returns. They don't need to see a single W-2. They are focused on one thing and one thing only: consistent cash flow. Then there are asset-based or asset depletion loans. These are for individuals who may not have a lot of monthly income, but are sitting on a significant pile of assets, stocks, bonds, retirement accounts. The lender uses a formula to calculate a monthly income from those assets over a period of time, allowing a wealthy but low-income individual, like a retiree, to qualify for a mortgage. There are also loans for real estate investors called DSCR loans, which qualify you based on the cash flow of the property you're buying, not your personal income. We will break down every single one of these in detail, but the fundamental principle is the same. They are all using alternative, but verifiable documentation to prove your ability to repay. It's not the Wild West anymore. It's a sophisticated, regulated, and data-driven system. It's just a different system. So, how does it actually work? How does a lender take a pile of your messy bank statements with money coming in and out, transfers, Zelle payments, and credit card processing fees, and turn that into a single simple number that says you can afford a $700,000 house? The math behind it is surprisingly straightforward, and once you understand it, you'll be able to look at your own finances through the eyes of an underwriter. You'll know in minutes whether you're likely to be approved, and that is exactly what we are going to do next. To do that, we need to get inside the head of a bank. Forget everything you think you know about loans for a minute. Forget the friendly loan officer, the glossy brochures, the promises of making your dreams come true. At its core, a mortgage is a cold, hard, calculated risk for a lender. They are giving you hundreds of thousands, sometimes millions of dollars, and they have one, and only one question that truly matters. What is the statistical probability that we will get our money back on time with interest? Every single rule, every piece of paperwork, every seemingly ridiculous request is designed to answer that one question. The entire traditional mortgage industry is built on a model of predictability. They love predictability. They crave it. And the most predictable thing in their world is a W-2 employee with a 2-year history at the same job. Why? Because it's easy. It's a clean, simple number. They can look at your pay stub, see your gross monthly income, plug it into a formula, and an algorithm spits out a green light or a red light. You fit neatly into their box. Your risk is quantifiable. But what happens when you don't fit in the box? What happens when you're a freelance graphic designer who made $150,000 last year? Or a real estate agent who closed $1 million in deals? Or a consultant who bills clients on a project basis? Your income isn't a straight line. It's a series of peaks and valleys. One month you might bring in $25,000, the next maybe only $5,000. To a traditional bank's algorithm, you look like a walking, talking red flag. You don't look predictable. You look chaotic. Let's invent a character. We'll call her Sarah. Sarah is a killer web developer. For the last 3 years, she's been working for herself, building an incredible client list. Last year, she grossed $200,000. She's disciplined, she saves aggressively, and she has a 20% down payment, $100,000 in cash. Ready for a $500,000 home she loves. On paper, Sarah's a success story. She feels successful. She walks into her local big-name bank, confident and prepared. She has her bank statements, a list of clients, and a proud smile. She's about to get a brutal reality check. The loan officer is friendly. He takes her information, sees her savings, and says, "This looks great. We just need your last 2 years of tax returns to verify your income." Sarah happily sends them over. And that's where her dream starts to die. The file goes to an underwriter. The underwriter doesn't know Sarah. They don't know how hard she works or how brilliant she is. They only know the numbers on the documents in front of them. And here's what they see. They look at her Schedule C tax form. At the top it says gross receipts, $200,000. Great start. But then they start scrolling down. They see all the deductions her accountant cleverly found to lower her tax bill. There's a $30,000 deduction for a new computer, software subscriptions, and office equipment. There's $10,000 for travel to client meetings and conferences. $5,000 for her home office deduction. Another $15,000 for paying other freelance contractors to help with big projects. All perfectly legal, perfectly smart things to do as a business owner. But the underwriter isn't an accountant. They don't care about saving you money on taxes. They care about risk. They add up all those deductions, $60,000 in total. They subtract that from her gross income of $200,000. Suddenly, in the eyes of the bank, Sarah didn't make $200,000. She made $140,000. But they're not done. Because she's self-employed, they apply what's often called a stability haircut. They might average her last 2 years of income. And maybe the year before she only made $90,000. So they average $140 and $90. Now her qualifying income is $115,000. But it gets worse. Because self-employed income is seen as less stable, some automated systems will only consider 75 or 80% of that averaged amount as truly usable for qualifying. So Sarah, who actually put $200,000 of revenue into her business account, is now being qualified by the bank as if she makes maybe $90,000 a year. Or less. Her real-world buying power has just been vaporized by a spreadsheet. Now comes the final nail in the coffin. The debt-to-income ratio, or DTI. This is the magic number for conventional loans. It's a simple formula. They take all your monthly debt payments, car loan, student loans, credit card minimums, plus your new proposed mortgage payment, and they divide it by your gross monthly qualifying income. Most traditional lenders want this number to be below 43%. Some go up to 50, but 43 is the gold standard. Let's do the math for Sarah. Her proposed mortgage, including taxes and insurance, is about $3,000 a month. She has a $400 car payment and a $300 student loan payment. Total monthly debts, $3,700. The bank decided her qualifying income was $90,000 a year. Divide that by 12 months and you get $7,500 a month. So they take her total debts, $3,700, and divide it by her qualifying income, $7,500. The result? Her debt-to-income ratio is 49%. The computer flashes red. Denied. Sarah gets a cold, impersonal email a week later. It says, "We regret to inform you that we are unable to approve your application at this time due to an excessive debt-to-income ratio." She is crushed. She has the down payment. She makes more than enough money to afford the payments. She knows it. You know it. But the bank's rigid, one-size-fits-all system doesn't. The system is designed for employees, not entrepreneurs. It punishes you for the very tax strategies that are essential to running a successful small business. This exact story happens thousands of times every single day across America. It's a silent frustration for millions of capable, credit-worthy people who are trapped outside the traditional system. They are told they are too risky, when in reality, the bank's method of measuring risk is simply outdated. It's like trying to measure the speed of a sports car using a sundial. The tool is wrong for the job. So, if the tool is wrong, how do you fix it? You don't. You find a different tool. You find a lender who has thrown out the old rulebook. A lender who understands that tax returns are a terrible way to measure the true cash flow of a business owner. This is the entire reason no documentation loans were reborn from the ashes of 2008. They exist to solve Sarah's exact problem. They operate on a beautifully simple and logical premise. The single best indicator of your ability to make a payment is your proven ability to make payments. It's not about what you told the IRS you made after a mountain of deductions. It's about the actual real spendable cash that flows through your bank accounts every single month. They are willing to look at what the traditional banks refuse to see. They are willing to measure your financial health with a tool that actually works for the modern economy. And that tool is your bank statement. How they do it, what they look for, and the different types of no-doc loans that use this common sense approach, like bank statement loans, asset-based loans, and more, is the key that unlocks the door for people like Sarah. It's time to open that door. So let's turn the first key. It's called a bank statement loan, and for millions of self-employed Americans, it's not just a key, it's a master key. This is the single most common and powerful tool in the non-traditional lending world. And the reason it exists is based on a fundamental, almost comical misunderstanding that traditional banks have about entrepreneurs. Think about it. As a business owner, a freelancer, a consultant, what are you and your accountant trying to do every single year? You're trying to legally minimize your taxable income. You're taking deductions. You're writing off expenses, your home office, your car, your equipment, that business lunch. You are actively and smartly working to show the IRS as little profit as possible. It's the smart business playbook. But then you take that tax return, the one that proudly shows you only made, say, $60,000 last year, and you hand it to a conventional mortgage lender. What do they see? They don't see a savvy business owner. They see someone who makes $60,000 a year. And they qualify you for a loan based on that number. It's a system that punishes you for being a good business person. The bank statement loan flips the entire script. The lender says, forget your tax returns. I don't want to see what you told the IRS you made after all your expenses. I want to see what your business actually brings in. Show me the lifeblood of your company, your cash flow. They ask for 12 or more commonly, 24 months of your business or personal bank statements. And they're not looking at your withdrawals. They are laser focused on one thing, your deposits. They want to see the consistency of money coming into your account month after month after month. This is the common sense revolution we talked about. A traditional lender looks at the bottom line on a tax return and sees the past. A bank statement lender looks at your deposits and sees the reality of your present and the potential of your future. They understand that a business generating $20,000 in deposits every month is fundamentally healthier than what a $60,000 a year tax return might suggest. So how do they actually turn those deposits into an income figure they can use to qualify you for a loan? This is where the magic happens. They don't just add up all your deposits and call it a day. They know you have business expenses. So they use what's called an expense factor, or an expense ratio. A very common expense factor is 50%. A lender might look at your statements, see you have an average of $20,000 in deposits each month, and they'll say, okay, we'll assume half of that, $10,000, goes to running your business. The other half, the remaining $10,000, we will count as your personal qualifying income. Suddenly, your $60,000 a year taxable income becomes $120,000 of qualifying income. Your borrowing power just doubled. The dream house that was completely out of reach is now comfortably within your budget. All because a lender chose to look at the reality of your cash flow instead of the story you told the IRS. For some businesses with lower overhead, like a consultant or a writer, a 50% expense factor might even be too high. In those cases, some lenders will allow you to provide a profit and loss statement or a P&L prepared by your CPA. If that P&L shows your business only has a 20% expense ratio, the lender might use that instead. Now, that $20,000 in monthly deposits, $16,000 of it is counted as your income. That's nearly $200,000 a year. This is how people like Sarah, our graphic designer, go from being rejected everywhere to being seen as a prime, well-qualified borrower. Her cash flow tells the true story that her tax returns were designed to hide. But what if you're not a high cash flow business owner? What if your story is different? What if you're an early retiree, an investor who lives off dividends, or someone who recently sold a business and is now sitting on a substantial pile of cash? You might have millions of dollars in assets, but if you walk into a traditional bank, the first question they ask is, where do you work? Show me your pay stubs. If your answer is, I don't have a job, the conversation is over. The door slams shut. For this person, we need a different key. This one is called an asset-based loan. It's also known as an asset depletion or asset utilization loan. And it operates on another beautifully simple, common-sense principle. If you have enough money to buy the house outright, you are probably a very good candidate to make monthly payments on it. Instead of looking at your income, these lenders look at your qualified liquid assets. We're talking about stocks, bonds, mutual funds, money market accounts, and even funds in a 401k or an IRA. They take the total value of these assets and use a formula to turn it into a monthly income stream for qualification purposes. Let's imagine a new character. Let's call him David. David is 55. He spent 30 years building a successful manufacturing company and just sold it for $5 million. The money is now sitting in a brokerage account. He has no debt and a perfect credit score, but he has zero income. He wants to buy a $1 million home by the lake to finally enjoy his retirement. A traditional lender won't even talk to him. He's unemployed. But an asset-based lender would be thrilled to talk to David. They look at his $5 million in liquid assets. Now the formulas can vary, but a common one is to amortize the assets over 360 months, the term of a 30-year mortgage. So, they take his $5 million and divide it by 360. The result is $13,888. That becomes David's qualifying monthly income, more than enough to comfortably afford the payments on a $1 million home. Other lenders might be more conservative. They might only use 70% of his stock portfolio to account for market volatility. So, they'd use $3.5 million instead of $5 million. Or they might amortize it over a shorter period, say 240 months. But no matter how you slice it, the result is the same. David, the unemployed retiree, is recognized for his immense financial strength and is easily approved for the loan. This isn't a loophole. It's logic. The system is acknowledging that wealth isn't just about a bi-weekly paycheck. It's about the total financial picture. A person with millions in the bank is not a high-risk borrower. They're the definition of a low-risk borrower. So you see, we have two different keys for two very different types of people who are ignored by the traditional system. The bank statement loan is for the earner, the person with high cash flow whose tax returns don't reflect their reality. The asset-based loan is for the owner, the person with high net worth whose lack of a W-2 doesn't reflect their reality. Both of these programs are built on looking at what is, not just what's on paper for the government. They are designed to assess true ability to pay. Now, hearing all this, the logical next question is, okay, this sounds great, but what's the catch? There has to be a catch, right? Are the interest rates astronomical? Do you need to put 50% down? Are there crazy fees? These are the critical questions. Because while these loans open doors, you need to know the price of admission. And understanding the trade-offs, the down payments, the credit score requirements, and yes, the interest rates, is the next crucial piece of the puzzle. So let's break down that price of admission piece by agonizing piece. Because when a lender agrees to not look at your tax returns, they aren't just doing you a favor out of the kindness of their heart. They are making a calculated business decision. And to balance their risk, they build a three-legged stool of security. If one leg is wobbly, in this case the income verification, the other two have to be made of solid steel. Those two legs are your down payment and your credit score. And the cushion you sit on, the interest rate, well, it's going to be a lot less comfortable. Let's start with the big one. The one that stops most people in their tracks. The down payment. In the world of conventional government-backed loans, you hear numbers like 3%, 5%, maybe even 0% down. Forget all of that. In the no-doc universe, those numbers don't exist. Here, the down payment isn't just a contribution. It's a commitment. It's your skin in the game. And lenders want to see a lot of it. They need to know that if the market takes a dip, or if your business has a slow quarter, you're not just going to mail them the keys and walk away. Your large down payment is their insurance policy. It creates instant equity, a protective buffer that makes their investment in you significantly safer. So what are the real numbers? The absolute bare minimum you'll typically see for a no-doc loan on a primary residence is 20% down. And that's for a borrower with a stellar credit profile and a straightforward property. More realistically, you should be prepared for 25 to 30% down. And if you're an investor buying a rental property, get ready for 30, 35, sometimes even 40% down. The lender's logic is simple. The riskier the scenario, and an investment property is always seen as riskier than the roof over your own head, the more of your own cash they need to see on the table before they'll put up theirs. Think of it as a trust fall. With a conventional loan, your 2 years of tax returns are the spotters, ready to catch you. With a no-doc loan, there are no spotters. So the lender needs you to start much, much closer to the ground. That massive down payment is what lowers you to a safe height. Now let's talk about the second leg of that stool, your credit score. If the down payment is your financial commitment to the property, your credit score is the story of your financial character. Since the lender is choosing to ignore the story told by your W-2s or tax returns, they are going to read your credit report like it's the most thrilling novel ever written. Every single line will be scrutinized. They aren't just looking at the 3-digit number. They're looking at the narrative behind it. Have you ever been late on a mortgage payment before? Do you have a long history of paying large debts on time every time? Or is your high score simply the result of having a couple of low-limit credit cards that you pay off each month? In the no-doc world, a 640 credit score might as well be a 440. It's a non-starter. The floor here usually begins around 680, and even then you'll be looking at tougher terms and higher rates. The sweet spot, where the best programs begin to open up, is north of 720. And if you really want the pick of the litter, you need to be in the 740, 760, or even higher club. A high credit score tells the lender that while your income might be unconventional, your payment habits are impeccably conventional. It proves that you are a reliable and trustworthy debtor, which is the single most important thing they need to know. They're making a bet that your past payment behavior is the best predictor of your future payment behavior. So if your credit has some dings and scratches, your first step isn't finding a no-doc lender. It's getting to work on credit repair, because that report is the one piece of documentation they will not, under any circumstances, ignore. And that brings us to the cushion we sit on, the interest rate. Let's be brutally honest here. The rate on a no documentation loan will be higher than the rate on a conventional loan. Period. There is no magic lender who will give you the same rate as your friend who just provided 2 years of perfect W-2s. This is the cost of convenience. It's the price you pay for the privilege of privacy and for the lender taking on that extra layer of perceived risk. This is what's known as a risk premium. You can think of it like this. If you want a package delivered tomorrow, you pay for express shipping. You're paying extra for speed and for bypassing the standard slower process. A no-doc loan is financial express shipping. You're paying a premium to bypass the standard 2-year income documentation process. How much higher are we talking? It fluctuates with the market, but as a general rule of thumb, you can expect a no-doc interest rate to be anywhere from 1.5 to 3 full percentage points higher than the best available conforming rates. So, if the best conventional rate is 6%, you might be looking at a rate between 7.5% and 9%. Yes, that's a significant difference, and over 30 years it adds up to a substantial amount of money. But here's the critical mindset shift you need to make. For most savvy borrowers, a no-doc loan isn't a forever loan. It's a for-now loan. It's a strategic tool. It's the bridge you use to get from the side of the river where you can't buy the property you want, to the other side where you own it. The goal isn't to keep this more expensive loan for 30 years. The goal is to use it to acquire the asset, the house, the investment property, the multifamily unit. You hold it for a year, 2 years, maybe 3. You make every payment on time, proving your ability to handle the debt. You continue to grow your business or your investments. And then once you have 2 years of that income seasoned and showing up on your tax returns, you refinance out of the no-doc loan and into a top-tier, low-rate conventional mortgage. You use the expensive tool to get the job done, then you put it away and switch to the more efficient one for the long haul. You're not just accepting a higher rate. You're strategically paying a short-term premium to secure a long-term asset. That's the secret. People who get stuck with these loans are the ones who see it as a permanent solution. People who thrive with them see it as a temporary, powerful key to unlock a door that would otherwise be sealed shut. So the price of admission is steep: a hefty down payment, an exceptional credit history, and a higher interest rate. It's a demanding trifecta that weeds out a lot of people. But for those who can meet these requirements, the disciplined saver, the diligent bill payer, the strategic thinker, it represents a pathway to wealth and homeownership that traditional banking has closed off. It's a different game with different rules. And now that you know the rules and the cost to play, the next question is the most important one of all. Where do you even go to find this game? You can't just walk into a Chase or a Wells Fargo and ask for one. So who are these shadow bankers? These specialized lenders operating in a completely different financial arena? Finding them is the real secret. They are not on Main Street. They operate in a parallel financial universe, a world built not on algorithms and checkboxes, but on relationships, risk assessment, and common sense. The key, the absolute gatekeeper to this entire world, is a very specific type of mortgage broker. Not the person you find in a cubicle at your local bank, who is technically a loan officer, an employee paid to sell you one company's products. I'm talking about a true independent mortgage broker. Think of them less as a salesperson and more as a financial matchmaker, a specialist who has a Rolodex filled with the private numbers of dozens, sometimes hundreds of these niche lenders. But before we dive into how to find this magic broker, you have to understand why this parallel system even exists. Why can't you just get this loan from the biggest banks in the country? The answer is a single word that changed everything: regulation. After the 2008 financial crisis, the government unleashed a fire hose of new rules, most notably the Dodd-Frank Act. This created something called the Qualified Mortgage, or QM rule. In simple terms, the government created a very specific, very rigid box. If a loan fits inside this box, meaning the borrower has a certain debt-to-income ratio, proven income via W-2s and tax returns, and good credit, it's considered a safe or qualified mortgage. The big banks like Chase, Bank of America, Wells Fargo built their entire business model around originating loans that fit perfectly inside this QM box. Why? Because it gives them legal protection. And more importantly, it allows them to immediately sell that loan to government-sponsored entities like Fannie Mae and Freddie Mac, getting it off their books, freeing up their capital, and eliminating their long-term risk. Their business is a volume game. It's an assembly line. They need every loan to be identical, standardized, and easily sellable. A self-employed person who wrote off half their income on their taxes? A real estate investor buying their 10th property? A foreign national with millions in overseas assets? Those people don't fit in the box. They break the assembly line. For a megabank, it's not worth the brain damage, the manual underwriting, or the regulatory risk to deal with them. So they just say no. This created a massive void in the market. Millions of creditworthy, successful, and often wealthy Americans were suddenly locked out of the traditional mortgage market. And where there is a void, capital will always rush in to fill it. This gave rise to the modern non-QM lending industry. Non-QM simply means any loan that falls outside that strict government-defined box. This is the world of the shadow bankers. So who are they really? They fall into a few main categories. First, you have the most classic players, hard money lenders or private lenders. These are often wealthy individuals, family offices, or small private funds. They use their own cash to make short-term loans, typically for 1 to 3 years. They are the financial SWAT team. They are incredibly fast, sometimes closing a deal in 7 to 10 days. They care almost exclusively about the quality of the asset, the property itself. If the deal is good and you're putting down a significant down payment, they're interested. They don't get bogged down by your tax returns. The trade-off? They are expensive. Their interest rates are much higher, and they charge significant upfront points or fees. They are a tool for a specific job, like fixing and flipping a house or securing a property quickly before refinancing into a more stable loan. But the real engine of the no documentation world, the place where most of these loans actually come from, is the second category: specialized non-QM lenders and portfolio lenders. These aren't just a few rich guys. These are sophisticated, multi-billion-dollar financial institutions. Companies you've probably never heard of, with names like Angel Oak, Citadel, or Verus. They don't have branches on every street corner. Their business model is completely different from a big bank. They don't sell their loans to Fannie and Freddie. Instead, they do one of two things. They either portfolio the loans, meaning they keep them on their own books and collect the interest payments themselves, or they bundle them up and sell them to hedge funds, insurance companies, and private equity firms on Wall Street who are hungry for the higher yields these loans provide. Because they aren't selling to the government, they are not bound by the rigid QM rules. They can create their own boxes. They can use common sense. They can look at 12 or 24 months of your business bank statements and see the real cash flow, not just what your tax return says. They can look at the rental income a property will generate and use that to qualify you, without ever looking at your personal income. They have the flexibility to underwrite the borrower in the deal, not just the paperwork. This is their entire business. They are built from the ground up to serve the clients the big banks turn away. And this brings us back to the broker. This world is a fragmented, confusing, and constantly changing landscape. A lender that has the best program for a self-employed doctor in Texas might have zero appetite for a real estate investor in Florida. Rates and guidelines change weekly. It is a full-time job just to keep track of who is doing what. You, as a borrower, could never navigate this alone. The broker is your guide. A good non-QM broker is a master storyteller. They take your unique, messy, out-of-the-box financial situation and they package it. They know how to present your 12 months of bank statements to an underwriter to paint a picture of a thriving business. They know which lender specializes in asset depletion loans for retirees and which one loves foreign nationals. They are your advocate. They submit your loan application not to one lender, but to 3 or 5, creating a bidding war for your business to get you the best possible terms. You are not their customer. You are their client. Their job is to represent you to the capital markets. So the million-dollar question is, how do you find one of these elite brokers? Because I guarantee you, if you just Google mortgage broker and call the first 3 names that pop up, you will likely strike out. Most brokers, probably 90% of them, make their living doing the same easy, conforming QM loans as the big banks. They don't know the non-QM world, and they'll probably tell you what you want is impossible. You have to be a savvy searcher. You need to go where the professionals go. The first place to look is at local real estate investor associations, or RAs. Go to a meeting. Network. Ask the people who are actually doing dozens of deals a year who they use for their financing. They will have a name. Second, go to online forums dedicated to real estate like BiggerPockets. Search the forums for discussions about non-QM, DSCR loans, or bank statement loans. You will see the names of brokers who are active in that space, recommended by investors over and over again. Third, find a real estate agent in your area who specializes in working with investors, not first-time homebuyers. That agent will have a go-to lender who can handle complex scenarios. And when you finally get a broker on the phone, you need to interview them. You need to ask the right question. Don't just ask, "Can you do a no documentation loan?" The magic phrase is, "Do you specialize in non-QM lending?" Or, "Which non-QM lenders do you work with most often?" Listen to their answer. If they sound confident, if they start rattling off the names of lenders and programs, you've found the right person. If they hesitate, if they say, "Let me look into that," they are not a specialist. Thank them for their time and move on. Finding the right broker is not just the first step. It is the most critical step. They hold the map and the keys to this entire hidden world of financing. Once you find them, a universe of possibilities opens up. Now you know who the players are and how to get a seat at the table. But what kind of games can you actually play? What are the specific loan programs they offer? This is where the real strategy begins. We're about to break down the playbook. The bank statement loan, the debt service coverage ratio loan, the asset depletion loan. Each one is a unique tool, a different key designed for a very specific type of lock. Understanding which key fits your situation is the next secret to unlocking your real estate ambitions. So let's start with the first key on our ring. The one that has single-handedly unlocked homeownership for millions of entrepreneurs, freelancers, and gig economy workers. It's called the bank statement loan. Now picture this. You're a consultant. You're incredibly successful. Your company brings in, say, $250,000 a year. You have a great accountant who completely legally uses every possible deduction to lower your tax burden. You write off your home office, your business travel, your marketing expenses, your software subscriptions. By the time you're done, your tax returns show a net income of maybe $60,000. To the IRS, you're a savvy business owner. But to a traditional mortgage lender, you look like you can barely afford a one-bedroom apartment. This is the exact problem the bank statement loan was designed to solve. It tells the lender, ignore the tax returns. They don't tell the real story. Look at the cash flow. Look at the money that actually comes into the business every single month. Here's how it works. Instead of asking for your W-2s or tax returns, the lender will ask for 12, or more commonly, 24 months of your business bank statements. They're not looking for individual transactions. They're looking for a consistent pattern of deposits. They want to see the lifeblood of your business. They'll add up all the deposits over that 24-month period and calculate a monthly average. Let's say over 24 months, you deposited a total of $480,000. That's an average of $20,000 per month. Now, the bank knows you have expenses. They're not naive. So they apply what's called an expense ratio. This is the most critical number in the entire calculation. Depending on your industry, they might assume your expenses are 50% of your revenue. So they take that $20,000 average monthly deposit, multiply it by 50%, and voila, they determine your qualifying monthly income is $10,000. That's $120,000 a year. Suddenly, you go from looking like you make $60,000 on paper to proving you have the cash flow of a $120,000 earner. That's the difference between being denied and getting the keys to your dream home. But, and this is a huge but, this isn't a magic wand. This key comes with a different set of rules. First, the down payment. For a conventional loan, you might get away with 3% or 5% down. For a bank statement loan, you should expect to bring 20%, sometimes even 30% to the table. The lender is taking a bigger risk on your income verification, so they want you to have more skin in the game. Second, the interest rate will be higher. Think of it as a convenience fee. You're paying a premium for the privilege of using an alternative method of proof. We're not talking predatory rates, but it will almost certainly be higher than the best advertised conventional rates you see online. This is the trade-off. You get access, but access costs more. The second key is for a completely different kind of person. This isn't for the entrepreneur buying their primary home. This is for the investor. This is the debt service coverage ratio loan, or DSCR loan. And honestly, it's one of the most powerful tools for building a real estate empire fast. The philosophy behind a DSCR loan is beautifully simple. If the property you're buying can pay for itself, then who cares what your personal income is? Your W-2 is irrelevant. Your tax returns are irrelevant. Your job is irrelevant. The only thing that matters is the property's ability to generate cash. Let's break down the math, and I promise to make it painless. Debt service coverage ratio. It sounds complicated, but it's just a simple division problem. You take the property's gross monthly rental income, and you divide it by the total monthly housing expense, which we call PITI: principal, interest, taxes, and insurance. Imagine you find a duplex that you can rent out for a total of $4,000 a month. You do the math, and the new mortgage payment, including the property taxes and the insurance, comes out to $3,200 a month. So you take the rent for $1,000 and divide it by the total payment, $3,200. The result is 1.25. That is your DSCR. To a lender, that 1.25 is a magic number. It means that for every $1 the property costs you each month, it brings in $1.25. It generates 25% more income than it costs to own. Cash flows. Most DSCR lenders are looking for a ratio of 1.2 or higher. If your ratio is 1.0, it means the property breaks even, which is too risky for them. If it's less than 1.0, it means you're losing money every month, and that's a definite no-go. Do you see the power in this? You could be a school teacher, a firefighter, or even retired. If you find a property with a strong DSCR, you can get the loan. This allows investors to scale their portfolio without being limited by their personal debt-to-income ratio. You can buy 2, 3, 10 properties this way, and as long as each one makes financial sense on its own, the lender will keep saying yes. Of course, this key has its own specific trade-offs. Just like bank statement loans, expect a higher down payment, typically 25% or more, and a higher interest rate. These are not owner-occupied loans. They are strictly for investment properties. And the appraisal becomes 10 times more important. The appraiser won't just determine the value of the home. They will also provide a market rent estimate. If their rent estimate is lower than yours, it can tank your DSCR and kill the entire deal. The property itself is the star of the show, and if it can't perform, the loan doesn't happen. Finally, we have our third key. This one is perhaps the most misunderstood and underutilized of them all. It's the asset depletion loan, sometimes called an asset-based or asset qualifier loan. This loan is for the person who is asset-rich, but income-poor on paper. Think about a retiree who spent 40 years building a massive nest egg. They have $2 million in a 401k, and another $500,000 in a brokerage account. But their only official income is a $3,000 a month Social Security check. A traditional lender would say they can't afford a new home. It's absurd, right? They're millionaires. Or think about the tech founder who just sold their company for $10 million. The cash is sitting in their bank account, but they haven't started their next venture yet, so they have zero income. How can they buy a house? This is where asset depletion comes in. The lender looks at your qualified liquid assets, things like stocks, bonds, mutual funds, and cash, and they turn it into a hypothetical monthly income stream. The calculation is surprisingly straightforward. They take your total eligible assets and divide it by a certain number of months, often the term of the loan, like 360 months for a 30-year mortgage. Let's use our retiree with a $2.5 million portfolio as an example. The lender might take that $2.5 million and divide it by 360. That calculation gives you nearly $7,000. The lender can now add that $7,000 to their $3,000 Social Security check, giving them a qualifying income of $10,000 a month. They went from being unable to qualify to being a very strong borrower, all without changing a single thing about their financial reality. It's simply a different, more logical way of looking at their true financial strength. The trade-offs here are similar to the others. Expect higher rates and a more specialized process. Not all lenders offer this, so you have to find one who understands it. And you need a substantial amount of liquid assets. This isn't for someone with $50,000 in a retirement account. Lenders need to see a portfolio large enough to sustain that depletion calculation over many years. They are essentially making a bet on your wealth, not your work. 3 different keys. The bank statement loan for the earner whose cash flow outpaces their tax returns. The DCR loan for the investor whose properties stand on their own 2 feet. And the asset depletion loan for the wealthy individual, whose net worth doesn't show up on a pay stub. Each one bypasses the traditional system by focusing on a different measure of financial strength: cash flow, property performance, or total assets. But focusing on that strength can also blind you to the hidden weaknesses. And that right there is where the dream of a no-documentation loan can turn into an absolute nightmare. Because for every story of a self-made entrepreneur finally buying their dream home, there's another, quieter story of someone who got trapped. We've just spent time looking at the shiny, powerful engines of these loans: the bank statement loan, the DSCR, the asset depletion loan. Now we have to look under the hood at the parts that can fail, because this isn't just about qualifying for a loan, it's about surviving it. The first and most obvious catch is the price tag. Let's be brutally honest. These loans are more expensive. We're talking about interest rates that can be 1, 2, even 3 full percentage points higher than a conventional Fannie Mae or Freddie Mac loan. And on a $300,000 mortgage, a 2% difference isn't just a few bucks. It's over $500 a month. It's $6,000 a year. Over the life of the loan, it's tens, sometimes hundreds of thousands of dollars in extra interest. And people hear this and they think, that's unfair. That's predatory. But you have to shift your perspective and think like the lender for a second. To a lender, a neat and tidy W-2 employee with a 7-year work history at the same company is a known quantity. They are a predictable, low-risk bet. Their income is documented down to the penny. But you? The freelancer, the real estate investor, the business owner? You represent uncertainty. Your income might be higher, but it's variable. It's less predictable. The lender is taking on more risk by betting on you. And in the world of finance, risk always has a price. They are charging you a premium for the flexibility you need. It's not personal. It's just a business calculation. But the interest rate is only part of the story. The next trap is the fees. Origination fees, processing fees, underwriting fees on these types of loans, they can be significantly higher. And then there's the big one, points. A point is a fee equal to 1% of the loan amount, paid upfront to the lender to lower your interest rate. In the no-doc world, you'll often see lenders requiring you to pay points not as an option, but as a condition of the loan. So you're already paying a higher base rate, and you might also have to shell out an extra $5,000 or $10,000 at closing just to get in the door. This is where the first major mistake happens. People get so focused on just getting approved, on hearing that magic word, yes, that they don't scrutinize the loan estimate. They don't compare the closing costs between lenders. They just sign on the dotted line, thrilled to be getting the house, only to realize later they've locked themselves into a financially draining product. But even that isn't the most dangerous trap. The most insidious, most financially crippling feature you will find hidden in the fine print of many no-doc loans is something called a prepayment penalty. Think about what that means. A penalty for paying back your debt early. It sounds completely backward, right? You're trying to do the responsible thing. Maybe you had a great year and want to pay off a chunk of your mortgage, or more commonly, you want to refinance into a lower-rate conventional loan, and the bank says, sure, you can do that. But you'll have to write us a check for $10,000 first. This is the golden handcuff of the no-doc world. Lenders put these penalties in place because they make their money over time from your interest payments. If you refinance after just 1 or 2 years, they lose all that future profit. So, the prepayment penalty is their insurance policy. Typically lasts for the first 2 to 5 years of the loan, and it can effectively trap you in that high interest rate loan, even if your situation changes dramatically. Imagine this scenario. You're a freelance graphic designer. For 2 years you've been crushing it, but you can't get a conventional loan because you don't have a 2-year history of tax returns showing stable income. So you get a bank statement loan at 6.5% with a 3-year prepayment penalty. A year later you land a massive, full-time creative director role at a major company. You now have a W-2. You have perfect credit. You could easily qualify for a conventional loan at 4%. You go to refinance and your lender says, "Great. Your prepayment penalty is 3% of the outstanding balance." On a $400,000 loan, that's a $12,000 fee you have to pay just for the privilege of leaving them. You're stuck. You're forced to keep paying thousands more in interest per year, all because of that clause in the fine print. Now, I know what a lot of you are thinking. Isn't this the kind of stuff that caused the 2008 financial crisis? That is the elephant in the room, and we have to address it. The term no-doc loan is haunted by the ghosts of 2008. The subprime mortgage crisis was fueled by what were called liar loans, stated income loans where a borrower could literally just state their income, with no verification whatsoever, and get a mortgage. It was a system ripe for fraud and abuse, and it ended in a global economic catastrophe. Here is the single most important distinction you need to understand. Today's no-doc loans are not the liar loans of 2008. The real term for them is alternative documentation, or alt-doc loans. After the crisis, sweeping regulations like the Dodd-Frank Act were passed. A core component of this was the ability to repay rule, which legally requires lenders to make a good faith effort to determine that you can actually afford to pay back the loan. They can't just take your word for it anymore. So when you get a bank statement loan today, they aren't just ignoring your income. They are verifying your income through a different method, your bank statements. When you get a DSCR loan, they are verifying the property's ability to generate income. They are still doing the math. The guardrails are up. The system is fundamentally safer than it was pre-2008. But safer doesn't mean risk-free. The risk has simply shifted from the lender taking a wild, unverified gamble to the borrower potentially taking on a complex, expensive product they don't fully understand. This brings us to the final, and perhaps most explosive hidden danger: the balloon payment. While less common now, some private money or hard money versions of no-doc loans still use them. A balloon mortgage works like this. You get a very low monthly payment for a set period, say 5 or 7 years. But it's artificially low because you're only paying interest, or your payments are calculated as if you had 30 years to pay it off. But you don't. At the end of that 5 or 7 year term, the entire remaining balance of the loan is due immediately, in one massive balloon payment. Imagine your mortgage payment is a manageable $2,000 a month for 5 years. You feel great. You're building your business, living in your home. And then on month 61, you get a bill in the mail for $350,000. Due in 30 days. The entire premise of a balloon loan is a gamble. You are betting that in those 5 years, you will either sell the property for a profit or your financial situation will improve enough to refinance into a traditional 30-year mortgage before that ticking time bomb goes off. But what if the market turns? What if your business has a down year right when you need to refinance? What if interest rates have skyrocketed? You can be left in a position with no good options facing foreclosure. So you've got higher rates that drain your monthly cash flow, fees that eat into your savings, prepayment penalties that trap you, and in some cases balloon payments that can be a financial guillotine. Sounds terrifying. Sounds like you should run for the hills and never look back. But for the right person, in the right situation, these are still the keys to the kingdom of homeownership and real estate investing. The secret isn't avoiding the risks. It's understanding them, anticipating them, and knowing exactly how to disarm them. And that process starts with finding the one person who can either guide you to success or lead you straight off a cliff: the lender. Because not all lenders in this space are created equal. Not by a long shot. Think of the mortgage world as two separate countries. The first country is the one everyone knows. It's the land of conventional FHA and VA loans. It's a place with bright streetlights, clear road signs, and federal guardrails on every corner. This is the world of qualified mortgages, or QM loans. The rules are standardized, the process is predictable, and the big household name banks are the gatekeepers. If you have a W-2 job, a great credit score, and a low debt-to-income ratio, you can cruise down this superhighway with ease. But no documentation loans don't live there. They live in the second country, the world of non-qualified mortgages, or non-QM. This place is more like a vast open frontier. There are incredible opportunities here, but the roads aren't all paved. The signs are sometimes handwritten, and the guardrails are few and far between. This is where the specialists, the innovators, and unfortunately the predators all operate. Your guide in this territory, your lender, is everything. Picking the wrong one is like hiring a tour guide who doesn't know the difference between a shortcut and a canyon. So where do you find the right guide? Your first instinct might be to walk into the big, marble-floored bank on the corner. Your local Chase, Wells Fargo, or Bank of America. You've had a checking account with them for years, they know you. But when you ask about a no-doc bank statement or DSCR loan, you'll likely be met with a blank stare. These institutions are built for volume and standardization. Their entire business model revolves around fitting borrowers into the neat, federally approved boxes of QM loans. The non-QM world is too specialized, too nuanced for their assembly line process. Going to a big bank for a no-doc loan is like going to a fast food chain and asking for a custom, 7-course gourmet meal. It's just not on their menu. This means you need to look elsewhere. Your journey will likely lead you to one of two places: a mortgage broker or a direct non-QM lender. Let's break them down. A mortgage broker is an independent guide. They don't have their own money to lend. Instead, they act as a matchmaker. They have relationships with dozens of different wholesale lenders, the actual institutions that fund the loans. A great broker is a master strategist. You tell them your story, your unique financial situation, and they know exactly which 5 or 6 lenders out of their network would be the best fit. They shop your scenario for you, comparing rates and programs to find the optimal path. They are your advocate, your translator, and your project manager all in one. For most people entering the non-QM space, a highly experienced broker is the single best asset you can have. Then you have direct lenders. These are the companies that actually have the money and create the loan programs. They are the source. Some of them work exclusively with brokers, while others also have a retail division that lets you work with them directly. Going direct can sometimes be beneficial, but it's like putting all your eggs in one basket. If their underwriting guidelines don't perfectly match your situation, you're stuck. You have to start the entire search over. A broker, on the other hand, can simply pivot and submit your file to a different lender in their network without you having to start from scratch. So the mission is clear. Find an expert broker or a direct lender who specializes in nothing but non-QM loans. But how do you tell the expert from the amateur? How do you spot the predator before they spot you? You do it by running every potential lender through a rigorous interview process, and you look for the flashing red flags. Red flag number 1. The too good to be true rate. You call a lender, give them a 30-second summary of your situation, and they immediately quote you a rate that's dramatically lower than everyone else's. Feels like you've won the lottery. You haven't. This is a classic bait and switch. They lure you in with a fantasy rate, get you to sign their initial paperwork, and encourage you to pay hundreds of dollars for an appraisal. Then a week or two later you get the call. "Oh, we ran into a little snag with underwriting," they'll say. "Unfortunately, your rate is going to be a full point higher, and we need a few extra thousand in fees." By then, you're so deep into the process you feel trapped. A true professional will never give you a locked-in rate until they've reviewed your actual documents. They'll give you a realistic estimate, but they'll manage your expectations. Red flag number 2. The high-pressure sales pitch. If a loan officer is creating a false sense of urgency, that is a massive warning sign. You'll hear things like, "This program is ending tomorrow, you have to lock in right now," or "Rates are about to skyrocket. If you don't commit today, you'll miss out." This isn't about helping you. It's about getting their commission. The non-QM lending space doesn't change on a dime. A good loan program will be there tomorrow. A legitimate professional will give you the space and the information you need to make a calm, rational decision. They sell with expertise, not with fear. Red flag number 3. The generalist. This is the most dangerous red flag of all, because it's the hardest to spot. You find a lender who seems nice and professional, but their real expertise is in conventional or FHA loans. They only dabble in non-QM. They're trying it out with your file. This is a recipe for disaster. They don't know the specific underwriting guidelines of the non-QM investors. They don't know how to properly structure your file. They don't know how to fight for you when an underwriter raises a question. You need a specialist. A Navy SEAL, not a weekend warrior. Ask them directly. How many bank statement loans have you personally closed in the last 3 months? If they can't give you a confident, specific number, they are not your guide. So what does a good guide, a green flag lender, look like? First, they ask 1,000 questions. A great non-QM specialist is a detective. They'll want to know everything. Not just your credit score and bank balance, but the story behind your business, the seasonality of your income, your plans for the property in 5 years. They aren't just filling out a form. They are building a narrative. They are constructing a compelling case to present to the underwriter, showing why you are a strong, creditworthy borrower, even if you don't fit in the traditional box. Second, they educate you. They don't just tell you what to do. They explain why. They'll break down the pros and cons of a 12-month versus a 24-month bank statement program. They'll explain exactly how the DSCR is calculated on a specific property and why it qualifies or doesn't. They'll present you with options, not ultimatums. They see themselves as a consultant and a partner in your success, not just a salesperson. And third, they are transparent. They will provide you with a detailed written loan estimate that breaks down every single fee. The appraisal, the underwriting fee, the title insurance, the origination points. There are no junk fees or vague processing charges. Everything is itemized. You will know down to the dollar exactly how much cash you need to bring to the closing table. Anything less is unacceptable. To find this person, you need to become the interviewer. Arm yourself with these specific questions and listen carefully to their answers. Question 1. What percentage of your total loan volume last year was non-QM? This cuts right to the chase. If the answer isn't over 50%, and ideally much higher, they are a generalist. Thank them for their time and move on. Question 2. Can you walk me through the most common reason a file like mine gets delayed or denied in underwriting? This is a brilliant question. An amateur will give you a vague answer. An expert will immediately tell you about potential issues with large, unsourced deposits in your bank statements, or how to properly document transfers between personal and business accounts. Their answer will reveal the depth of their experience. And question 3. Which specific wholesale lenders do you think would be the best fit for my scenario and why? This shows you've done your homework. It forces them to demonstrate their strategic thinking. They should be able to name specific lenders, like Angel Oak, or Carrington, or Citadel, and articulate why that lender's particular bank statement or DSCR program is uniquely suited to you. Once you've found this A player, this specialist who speaks your language, you're halfway there. But now the ball is in your court. You have to hand them a file so clean, so organized, and so compelling that an underwriter can't help but say approved. And that's exactly what we're going to build piece by piece in the next part. So let's talk about what that file looks like. This isn't just about gathering documents. This is about building a case. You are the lawyer, and your financial life is the client. The underwriter is the judge. Your mission is to present a case so clear, so logical, and so overwhelmingly positive that the only possible verdict is approved. The first and most important rule is this: make the underwriter's job easy. An underwriter reviews dozens of files a day. They are trained to spot inconsistencies, red flags, and missing information. Every question they have to ask, every document they have to chase down, adds friction and doubt to the process. Your goal is to anticipate every question and answer it before it's even asked. You want the underwriter to open your file, see everything perfectly laid out, and feel a sense of relief. You want them to think, finally, an easy one. So let's build this masterpiece, starting with something 99% of borrowers never even think to include: a cover letter. Call it a loan submission summary. This is a one-page cheat sheet for your entire file. It's the first thing the underwriter reads, and it sets the tone for everything that follows. It should briefly and professionally outline 5 key things. 1. Who you are, a brief professional bio. 2. What you're buying, the property address and its key features. 3. The loan you're requesting, the loan amount, the down payment, and the type of loan, like a 12-month bank statement loan. 4. A summary of your qualifications, your credit score, total liquid assets, and the average monthly deposits shown in your bank statements. And 5. A concluding sentence expressing your confidence in the deal and your readiness to provide any further information. This single page transforms you from a faceless application number into a credible, organized, and serious borrower. It shows you respect their time and you've done your homework. Next, the fundamentals. The boring but non-negotiable stuff. Your identity documents. This means a crystal clear, unexpired copy of your driver's license or passport. It means your social security card. Make sure the copies are so high quality you can read every single letter. If your name on your ID is slightly different from your name on your bank account, say one includes a middle initial and the other doesn't, address it in your cover letter. Proactively solve the puzzle for them. This section is about precision. No blurry photos, no expired IDs. Get it perfect. Now we get to the heart of the no-doc loan. Proving your financial strength without tax returns. This is where your story is told through your assets and cash flow. The primary tool here is your bank statements. Most lenders will ask for 12 or 24 months of statements for all of your primary business and personal accounts. And when they say all pages, they mean all pages. Even the blank one at the end that just has legal disclosures on it. A missing page is an incomplete file, and an incomplete file is a delayed file. But just handing over a stack of statements isn't enough. You need to understand what the underwriter is looking for. They are not just looking at your ending balance. They are detectives piecing together the story of your financial life. They're calculating your average monthly deposits to establish a consistent income stream. They are looking for large, unusual deposits that don't fit your normal pattern of business. A one-time $50,000 deposit from an unknown source is a massive red flag. So you get ahead of it. You create a document called a letter of explanation or LOX. For every large deposit, you write a simple one-paragraph explanation. On May 15th, my business account shows a deposit of $50,000. This was the result of selling a piece of business equipment, and I have attached the bill of sale for your reference. Boom. Question asked, question answered. Mystery solved. They are also scanning for non-sufficient funds charges or NSFs. Overdrafts. Bounce checks. These are poison to an underwriter. They suggest poor financial management. If you have one or two from a year ago, write a LOX explaining the situation. If you have them frequently, you need to seriously reconsider if you're ready, and maybe wait a few months to establish a cleaner history. The goal is to present a picture of stability and predictability. Your bank statement should tell a story of money consistently coming in, being managed responsibly, and accumulating over time. Beyond bank statements, you need to document all your other assets. This is about building a picture of overwhelming financial depth. Gather your brokerage account statements for the last 2 or 3 months. Your 401k or IRA statements. These show the underwriter that you have a safety net. You have long-term wealth, not just month-to-month cash flow. This is a huge compensating factor. If you have assets in cryptocurrency, this gets tricky. Most lenders are still wary of it. The best way to handle this is to liquidate the crypto you plan to use for the down payment or reserves well in advance, at least 60 to 90 days before applying, and let it season in your bank account. Then it just looks like cash. If you can't do that, be prepared to provide a full paper trail from the exchange, showing the transaction history and its conversion into US dollars. Next up, the property itself. Remember, in a no-doc loan, the property is not just collateral. It's a cosigner on your loan. The lender needs to be absolutely certain that if you default, they can sell the property and recoup their investment. This means your purchase agreement needs to be clean and fully executed, and the appraisal becomes the single most important document in the file. A strong appraisal that comes in at or above the purchase price, with no major repair issues noted, gives the lender immense confidence. While you don't directly control the appraiser, you can prepare the property. Make sure it's clean, accessible, and all minor visible repairs are taken care of before the appraiser shows up. First impressions matter even for a house. Finally, we assemble your secret weapon, the compensating factors. These are the elements that push a borderline file into the approval pile. Your credit score is the king of compensating factors. A score above 740, or even 760, screams financial responsibility. It tells the underwriter that you have a long documented history of paying your debts on time, every time. Before you even talk to a lender, pull your own credit report. Dispute any errors. Pay down any high balance credit cards to boost your score. Walk into this process with the highest score you can possibly achieve. Your letter of explanation, the LOX we talked about, is another powerful tool here. Don't just use it for large deposits. Use it to explain anything that might look odd. A recent flurry of credit inquiries? Explain you were shopping for a car. A previous address not showing up? Explain you were renting from a family member. Be brief, be factual, be professional. And for my self-employed people, the entrepreneurs, the freelancers, I want you to add one more thing, a one-page business narrative. Who are you? What does your business do? How long have you been doing it? What's your competitive advantage? Don't write a novel. Just a few professional paragraphs that give the underwriter context. It humanizes your bank statements. It turns those deposits from abstract numbers into revenue from a real thriving business. Attach your professional licenses, certifications, or even a link to your business website. You're not just a pile of numbers, you're a successful professional. Prove it. When you put all of this together, the professional cover letter, the pristine identity docs, the well-explained bank statements, the deep asset portfolio, the strong property appraisal, and the compelling compensating factors, you've done something remarkable. You have transformed your application from a gamble into a calculated, low-risk business decision for the lender. You've removed all the friction, answered all the questions, and told a compelling story of financial success. You've taken control of the narrative. Now the underwriter isn't digging for problems. They're simply checking the boxes on a file that already makes perfect sense. You've built the perfect package. It's organized, it's compelling, and it's ready. But submitting the file is just the final step of the pre-approval process. Now you have to navigate the final crucial phase, getting from that conditional approval to the closing table with the keys in your hand. And this is where many deals fall apart, undone by small last-minute mistakes. Avoiding those pitfalls is the final piece of the puzzle. So what are these deal-killing mistakes? The first, and by far the most common, is what I call the finish line fallacy. It's the belief that a conditional approval means the race is over. It's not. It's the final lap, the most critical part, and your lender is watching you like a hawk. The number one way borrowers trip themselves up here is with new credit. You're excited. You've been approved for the house. You start picturing the furniture, the new big screen TV, the car you'll finally have space for in the garage. So you go out and open a new credit card at the furniture store, or you finance a new vehicle. This is financial suicide at this stage of the game. Even with a no-doc loan where your income isn't the primary focus, your overall debt profile is still under a microscope. A new loan or a maxed-out credit card dramatically alters your debt-to-income ratio, even if it's just a background metric for the lender. It screams instability and recklessness. The underwriter, whose job is to minimize risk, sees this new activity and a giant red flag goes up. They'll pull your credit one last time, sometimes on the very day of closing, and if they see that new car loan, the entire deal can be canceled instantly. Think of it this way: you've just run a 26-mile marathon, you can see the finish line, and you decide to pick up a grand piano and carry it the rest of the way. It's an unforced error that can cost you everything. From the moment you get that conditional approval until the keys are physically in your hand, your wallet is in lockdown. No new credit, no new loans, no co-signing for anyone. Don't even breathe on a credit application. The second major pitfall is the last-minute money shuffle. The lender has verified your assets. They've seen your bank statements and confirmed you have the funds for the down payment and closing costs. They need to see that this money is seasoned, meaning it's been sitting in your account for at least 60 to 90 days. What they absolutely cannot see is a large, sudden, undocumented deposit a week before closing. Maybe your parents decided to give you a $10,000 gift to help with closing costs. That's wonderful, but if it just appears in your account as a random transfer, the underwriter will hit the brakes hard. Why? Because in the world of lending, a large unexplained deposit is a massive red flag for an undisclosed loan or, even worse, money laundering. Every dollar has to have a paper trail. If you are receiving a gift, it must be properly documented with a formal gift letter, signed by the person giving you the money, stating explicitly that it is a gift and not a loan that needs to be repaid. Without that documentation, the lender will not count those funds, and if you were relying on them to close, your deal is dead. So, if you anticipate any help from family, have that conversation and get the paperwork sorted out months in advance, not days. Keep your accounts clean, stable, and predictable in the final stretch. The third pitfall is employment instability. Now, this sounds counterintuitive for a loan that doesn't verify income, right? But it's not about the dollar amount you earn. It's about the stability of your situation. Lenders are betting on your ability to repay over the long term. If you're a self-employed consultant, they've approved you based on the fact that you are a self-employed consultant. If you suddenly close your business and take a salaried job 2 weeks before closing, you have fundamentally changed the entire basis of the loan application. The deal is off. Even though they didn't ask for tax returns, they may still do a final verbal verification of employment. They might call your company just to confirm you still work there. Or if you're self-employed, they might do a quick check to see that your business is still active and in good standing. Don't make any major career changes until after you've closed on the house. Now, let's talk about the final steps that get you to the table. First, secure your homeowner's insurance. Don't leave this to the last minute. Get quotes early, choose a policy, and get the binder, which is proof of insurance, to your lender as soon as possible. Closing can be delayed for days waiting on this simple piece of paperwork. Second is the final walkthrough. This is not a formality. You need to visit the property 24 to 48 hours before closing. You are checking to make sure the home is in the same condition as when you sign the contract. You're making sure that any agreed-upon repairs have been completed. You're testing the appliances, flushing the toilets, checking for any new damage. If the seller was supposed to leave the washer and dryer and they're gone, you address it now. Not after you own a home with a flooded laundry room. And then comes the day itself. Closing. You'll sit at a table with a closing agent or attorney, your real estate agent, and a stack of paper that looks like a phone book for a small city. Don't be intimidated. The most important document you will see is the closing disclosure, or CD. You are legally required to receive this document at least 3 business days before closing. Your job is to compare it line by line with the loan estimate you received at the beginning of the process. Are the numbers the same? Is the interest rate correct? Are the closing costs what you expected? If there are discrepancies, you ask questions. You do not sign until you understand every single number you are agreeing to. You'll sign your name until your hand cramps, you'll hand over a cashier's check for your closing costs and down payment, and then you'll be handed a set of keys. And just like that, you're a homeowner. But the story doesn't end there. Getting the keys is the end of the beginning. Now you need a long-term strategy. Remember, this no documentation loan was a tool. A powerful specialized tool that got you into the asset. It likely came with a slightly higher interest rate than a conventional loan. Your mission, should you choose to accept it, is not to keep this loan forever. Your mission is to use it as a bridge. For the next 12 to 24 months, you make every single mortgage payment on time. No exceptions. If you're self-employed, you work with your accountant to ensure your next 2 years of tax returns show a strong, stable, and verifiable income. You build a track record. Because after you have that track record of perfect payments and 2 years of solid tax returns, you unlock the final level of the game. Refinancing. You can now walk into any conventional lender, present your 2 years of W-2s or tax returns, show them your perfect mortgage history, and refinance out of your no-doc loan and into a prime, low-interest, 30-year fixed-rate conventional mortgage. You use the specialized tool to acquire the asset, and now you're trading it in for the standard, most affordable tool for the long haul. This is how you turn a temporary solution into a permanent victory. So, the truth about no documentation mortgage loans? They aren't a myth, and they aren't the shady liar loans of the past. They are a legitimate, vital financial pathway for the millions of Americans whose success doesn't fit on a pay stub. They are for the entrepreneurs, the freelancers, the commission-based salespeople, and the innovators who are building the backbone of the modern economy. It's a process that demands more from you. More diligence, more financial discipline, more documentation of your assets. But it acknowledges that a person's worth and their ability to pay their bills isn't solely defined by a W-2. It's a recognition that the American dream shouldn't be reserved only for those with a traditional 9-to-5. If you're one of these people, know that this path exists. It's challenging, but it is absolutely achievable. You can own a piece of America. You just have to prove it in a different way.